Hi, I'm James Daniel, and today's episode of Personal Finance FYI is part one of our deeper dive into the concepts and strategies outlined in the new Tony Robbins book, Money Master the Game. So are you ready to get started? Personal Finance FYI starts now. And welcome back to Personal Finance FYI, the web program designed to help you make smart financial decisions and to grow your wealth. Well, after about a dozen phone calls from people that had read the Tony Robbins book and were looking for a fiduciary advisor, I figured it was time for me to actually sit down and see what kind of financial advice he was dispensing. As a financial planner, I was naturally a bit skeptical. Just who did this life coach think he was trying to give people financial advice? But in all honesty, after reading the book myself, I was impressed. It is well put together and contains a good balance of financial strategies and motivational advice. I definitely think it's a worthy read, if for no other reason than it gets you thinking about your overall financial plan. Now, one thing I thought might be helpful for those of you that had read the book was to expand on some of the investing ideas and concepts that were outlined. So today we are going to take a closer look at the portfolio strategies of David Swensen with Yale Endowment and Ray Dalio's all-season strategy, along with some various index strategies promoted by John Bogle of Vanguard and Chuck Schwab of, Schwab. In the book, Tony has interviewed many of the smartest minds in the investing world, all uber wealthy folks, and he poses the question to them. If you could leave none of your assets but only a set of investing principles to your kids, what would they be? So let's begin with a discussion of David Swensen's portfolio. David became famous in the investment world as head of the Yale Endowment Fund and the portfolio model he co-developed. The endowment model produced an average rate of return in the high 13% range per year for most of the 90s and 2000s. He went on to write a book regarding the strategy, and many institutions have tried to emulate it. One thing to realize is that the portfolio shown in Tony's book is not the endowment model. The endowment model is weighted heavily towards alternative investments. The average investor is not well suited to mirror an endowment, as your time frames are just a bit different. An endowment is something that actually exists in perpetuity, and unfortunately you aren't. An endowment fund can handle long periods of illiquidity and can take larger risks to get bigger returns, since they aren't concerned with petty little things like retirement. With that said, Mr. Swensen acknowledged this and in the interview proposed the following portfolio for the retail investor. Now, I backtested this portfolio and found it had a decent average rate of return over the longer period. Now, it is basically a 70-30 stock to bond style allocation. However, knowing most investors are looking for an edge, it got me thinking that many of you might be interested in learning how you could take an index style portfolio such as this and combine it with some of the features of the endowment strategy to give you the opportunity for a better risk adjusted return. Toward the end of the broadcast, we will touch on that using liquid alternatives. And now, next up in the book was a chapter that focused on a conversation with Ray Dalio. Ray runs the largest hedge fund in the world and has produced many white papers on various strategies. The one that has garnered the most attention was what he called the all-season strategy. His premise and research led him to create a portfolio model that could handle inflation, deflation, rising economic growth, and falling economic growth, all while limiting downside risk. While this may sound a little too perfect to be true, in back-tested models, it does perform fairly well over a long period of time. Now, this most definitely doesn't mean that the portfolio performs well every single year. But if you have a long enough time frame, it is definitely something to consider. Now, the all-season portfolio is a bit different in that it is lighter on stock, heavier on U.S. bonds, and adds in gold and commodities. In backtesting this portfolio myself, I did find it to give a nice risk-adjusted return over the long period. And that is the key. Whether employing the Swensen strategy or the all-season strategy, or some of the other index strategies we will discuss, you have to understand that there will be months or even years of underperformance. As with any strategies, they only work if you stick with them over the long term and not give up based on 1 or 2 years of underperformance. What ends up hurting the average retail investor is chasing ideas and then giving up during their first period of underperformance. Now, the Swensen strategy took about a 30% hit in 2008, whereas the all-season strategy was only down about 3.8%. However, when stocks were outperforming the past few years, the all-season portfolio underperformed due to its higher exposure to commodities, gold, and bonds. It's just not possible to get the best of both worlds of lower risk and higher returns. In the book, Tony also interviews John Bogle, the founder of Vanguard, as well as Chuck Schwab. Both men promoted the idea of lower fee index style funds as the sort of core of an investor's portfolio. One interesting item was that after promoting the low fee structure index funds, Tony went on to interview Mary Erdos of JP Morgan. She heads up their mutual funds, which are actively managed funds. The takeaway here was that in the broader market, it is harder to beat the major indexes, so lower fee index style funds are key. However, layering in actively managed funds in asset classes that may not be quite as efficient can potentially add value. So I've summarized a couple of the portfolio strategies outlined in the book. Many incorporate index-style investments for the major asset classes, and some even add in commodities. The idea with any investment model that you use is that you're trying to achieve a desired rate of return over a certain amount of time with a certain amount of risk, or what we call risk-adjusted return. You do this by following an asset allocation model and diversifying your investment across many non-correlated investments. Non-correlated simply means that things just don't necessarily move together. You start with a core and then you gradually layer in additional investments that for the same risk are expected to increase your return, or for the same return are expected to decrease your risk. The Yale Endowment found that by adding alternative assets such as private equity, hedge funds, non-traded real estate, timberland, managed futures, etc., that they could reduce their exposure to the stock markets and still get plenty of upside. For you and me, investing in some of these items has been off limits unless you were an accredited investor. However, many of these strategies are now available in what we call liquid alternative funds that anyone can invest in. While they don't exactly mimic their non-traded counterparts, many of the liquid alternative strategy funds do allow investors the ability to add more diversification to their portfolio. It's really just a matter of doing your homework to see what you can add to your portfolio that will increase your risk-adjusted return. So a couple of key takeaways. Number one, core portfolios with lower fee structure funds are key. Number two, adding assets that give you more potential return for the same amount of risk or lower your risk for the same potential return is key to asset allocation. Number three is no one particular strategy works best. The optimal approach is to look at the goals you are trying to achieve and formulate your investment strategy around that. And number four, above all else, if you can't figure it out yourself, then go hire a fee-only fiduciary advisor to do it for you. Now, in our next episode, we will continue our discussion of the Tony Robbins book with a deeper look into the annuity, life insurance, and tax strategies that he discussed. Until next time, I'm James Daniel, and I will see you on the next Personal Finance FYI.